Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. As you all know, investing in alternatives, particularly private equity and private credit, have been gaining in popularity and capturing headlines for the benefits they offer. Because of that, I'm very excited for today's episode. I think you will too. It's going to be a very engaging and entertaining conversation as I have on an industry recognized leader in the private market space. But first, today's episode is sponsored by the award-winning Zephyr, which helps advisors, wealth managers, financial analysts, and investment professionals make more informed investment decisions. So with that, I'd like to move on to the star of the show. So I'd like to welcome Dr. Dorothy Kelso to the show. Dr. Kelso is the brand strategy director and global head of SuperReturn, which is a globally recognized series of conferences, online communities, awards, and e-magazines in private markets. Dr. Kelso is also the creator of the very popular upcoming Fund Managers Weekly newsletter. Thank you so much for joining the show, Dorothy. I really appreciate it. So can you start by telling us a bit about yourself and SuperReturn?
Sure, and thank you, Ryan. I'm super excited to be here talking to you today. So I've been head of SuperReturn for 7 years now. And as you mentioned, SuperReturn runs a series of conferences across the globe and has market intelligence as well. And we are probably the preeminent brand in private markets for conferences, not trying to sound boastful, but you just have to ask around. And I've been in private markets for 20 years. I'm giving away my age a little here.
It looks like you've been in for 5 years.
Oh, Ryan,
at all.
Thank you for that. I really appreciate that. Can I have that in writing, actually? Previously, I was at firms like Collar Capital, which is a private equity firm. I've been at EY, which, of course, everyone knows is a big four firm, and consulting and not-for-profit trade organizations. So I have been at different types of organizations in the industry. And in my spare time, I'm a trustee of a charity in Tunbridge Wells, mental health resources charity. And as you mentioned, I also do the upcoming fund manager interview series in my spare time to support emerging managers raise their profile.
So you're busy.
I'm busy. I think I need some time out.
There you go. There you go. Well, you deserve it. So maybe soon you can take a trip to the US or something.
I'd love that. Love that.
It has been a very interesting investment in macro environment recently, really since the pandemic. But over the past year, the Fed and other central banks around the globe have employed its steepest rate hiking policies in 40 years to fight inflation. It is looking more and more likely that interest rates are going to remain higher for longer. Furthermore, labor markets remain extremely tight. And positive economic growth continues and remains resilient, as do equity markets. Equity markets have had a fantastic 2023 so far. How has this investment in macro environment impacted private investments?
Yeah, I mean, you're completely right. The global economic conditions have been a bit challenging. And then layer on that some geopolitical tensions as well. I mean, things have definitely slowed down in private markets. In the good years, there's a virtuous cycle. So, when private equity firms sell, they exit their companies, that leads to money back to institutional investors. They have money then funds, fundraising goes up, deals go up, that helps exits, and then the cycle continues, and that has slowed down. So according to Bain Capital, half one exits and buyouts were down 65% year on year. Fundraising year on year in H1 down 20%. Deal volumes, buyouts down 58%, and then venture has even been more hard hit. So things are definitely slowing down. But, you know, aside from all that apparent negativity, institutional investors are very much committed to the long term, to the asset class, you know, and are there to weather its ups and downs. You know, a lot of funds are 10-year funds, 12-year funds, and it's in the down times that actually some of the best deals have been done. So, you know, those I call them LPs, they're institutional investors, those that have money to invest are really still putting money to work, and those that don't are looking at different strategies to get some liquidity. So yeah, you're completely right. Things have been tough, but you know, there is still opportunity for those that, you know, have the capital to invest.
Very interesting. So is it this downturn or, you know, headwinds that we're facing here, is it because of the higher interest rates and higher borrowing costs that's causing it?
It is. It's a combination of many things. There's the higher borrowing costs, it's the inflation, you know, making everything a lot more expensive. It's uncertainty over what valuations should actually be. Because in the good times, valuations kept going up. And suddenly you're faced with, you know, some background factors like we've talked about, interest rates, geopolitical conditions, and inflation. And then, you know, people are quite uncertain what things should be valued at exit. So then they hold on to their portfolio companies a bit longer, try to do some more value creation. So I think that is what's happening right now.
So then that begs the question, when interest rates are cheap or at zero, like we've had for a decade or longer, very low interest rates, that typically then bodes well for private investments and LPs and firms that are offering private investments, I'm assuming.
It does, and it does on the one hand, but on the other, if high interest rates are here to stay, private equity firms will innovate and adapt to the new normal. I think it's more about the change that happened, and quite rapidly, that people just drew back and waited to see what would happen. And I think there is a feeling now generally that, okay, we've probably weathered the worst, and aside from some big, you know, disruption happening, people are starting to think, okay, it's time for the markets to get moving again.
Interesting. It's, you know, on the other side, you know, as financial advisors or on the buy side for retail investors, you know, we often talk interest rates will move. There's nothing unnatural about interest rates rising or falling, but it's the pace and that really impacts investments in markets of, you know, interest rate hikes. And we've seen, like I said, the steepest interest rate hike environment in 40 years. So obviously that's going to impact a lot of markets.
Yeah, 100%.
So what are some trends you mentioned? You know, it's a tough environment right now, but what are some other trends maybe you are seeing or hearing about in private markets?
So the obviously mentioned that, you know, the tougher ones, you know, it very much depends on where the fund manager is focused. So venture capital, you know, after the Silicon Valley Bank the crisis, let's just call it, you know, venture capital is very much down. Buyouts have slowed, you know, with the interest rates, but there are some exciting areas at the moment. So private credit is doing quite well. So it's got structural factors behind its growth as well. So banks are largely withdrawing from this type of lending. So it's creating a gap which is being filled by private credit firms. So this is seen as a huge multi-trillion-dollar potential market segment. And even at SuperReturn, we're seeing huge appetite for anything private credit related.
Okay.
Yep, and fund sizes are growing. You know, I think the average fund size for private credit about 10 years ago was probably, you know, up to about 500 million, and now it's about 1 billion. So private credit is doing strongly in this market. Secondaries do well whenever there's market disruption. This is where, you know, it effectively gives liquidity in an otherwise illiquid asset class. So both institutional investors and fund managers can use secondaries to get liquidity. So institutional investors can sell stakes in their fund, you know, the 10-year funds that they're invested in, and fund managers can use secondaries as a way to exit their portfolio. So secondaries, private credit, energy transition, anything to do with renewables, also doing well. yeah, so those are some of the positive and exciting trends we're seeing in private markets at the moment.
Fantastic. Is I'm hearing more and more, reading more and more about private credit, so that's not a surprise. And our listeners, they could probably tell because of your fantastic accent that you are overseas and you're located in London. So when you talk about these trends or what's happening in the private space, are you talking? Is it more global trends? Is because Super Return is a global brand, have conferences all over the world, or is it more driven by what's happening in the US, or is it truly more of a global environment?
That's an excellent question. And some of these trends are very much focused on North America and Europe.
Yeah.
Private credit, I'd point to that particular one, that Asia is only just developing its private credit market. Having said that, things like energy transition are global. The huge appetite for renewables in Asia. So I'd say a lot of these are global. And also when we think about it, although fund managers might have a regional focus, many of the institutional investors are actually global. Some of the huge Canadian pension funds, the US pension funds, they're looking globally for opportunities in different markets. So yes, I'd say, very much depends on which geography you're in, but largely some of the trends do apply globally.
Great. Yeah, I've always wondered that when we talk about private markets, is it as segregated, you invest, in US or North American stocks versus foreign. So great insights there. Thank you. I attended an investment conference recently, and I'd say, gosh, 85% of the conversation centered around alternatives. Demand from investors and financial advisors for private investments, particularly private credit, like you said, has spiked. Are providers of private investments answering that growth and demand from the buy side? Are they answering that call?
The short answer, yes, they are. Private markets is one of the most innovative, I think, maybe I'm slightly biased, but I feel that they're highly innovative and they're very nimble. And if investors want to put money to work, fund managers will evolve strategies in order to facilitate that. And, we do see spin outs from existing fund managers, which helps increase the number of fund managers in particular segments. Like private credit, for example, is probably likely to see more spin outs if it's growing. We see new strategies. Asia, I mentioned private credit earlier, is still nascent in Asia. But private equity and private markets generally in Asia is also booming. So yes, they're answering the call 100%. They're very innovative, very nimble.
Great. At the intro, you had mentioned that you were going to switch a little bit here, a very big advocate of emerging managers, and your very popular newsletter, podcast, Upcoming Fund Managers weekly newsletter is very popular. So you obviously talk to a lot of emerging managers in the private space. Are you seeing more growth in the new emerging managers lately?
That's a really good question, Ryan. Things have been tougher now for emerging managers, and part of what I do is to try and support them to get profile in quite a tough market. Having said that, there are a lot of them, so many will be successful, and emerging managers do provide advantages to institutional investors. They allow them to diversify their portfolios away from larger, more established funds or strategies. Many emerging managers will have some sort of innovative model or approach that's worth investing in, and they also allow access for investors to potentially high-performing fund in future. Once these fund managers get established, it can be more tricky for institutional investors to get access to them. So getting in early is good. And in some of the interviews I've been doing, I've seen a lot of strategies around climate and renewables, which I mentioned earlier, private credit, secondary. So in some ways, where the institutional investors want to invest, those are the areas in which emerging managers are also focusing.
Interesting. You kind of touched on it there at the beginning, but what are there other benefits to emerging managers that maybe they offer investors?
Yeah, some say they have some emerging managers, the right emerging managers have higher performance. They potentially could be more driven.
Mm-hmm.
But the data on this, as you can imagine, is quite private. So it's very difficult to actually get benchmarks on it. But some institutional investors, I know some of the US ones, for example, do say that they do have emerging manager programs and they don't sacrifice performance in order to have those programs. So I'd say performance, access to innovative strategies, and diversification as well. Those are some of the benefits.
Fantastic. What are some misconceptions about private investments, or you could talk about emerging managers also? Are there any misconceptions out there?
There have been a few over the years. I probably will repeat some of them. The press have been quite happy to mention them. I will say one, though, that a lot of people still see it as only available to the institutions and the very wealthy. People like you and I aren't seen to be able to have access to it, but that is very much changed. Well, I think so, Ryan. I don't know if you're
No, no,
most
Dorothy,
wealthy.
you were exactly right. No, I'm looking at ETFs and mutual funds where at the very low buy-in.
Okay, so maybe us then. I can include you. So that's very much changing, and we're seeing many new platforms allowing access for the mass affluent, and I think that will also then in turn help debunk any myths about private investments.
Interesting. Fantastic insight, Dorothy. I had a strong feeling that you were going to drop a lot of good insights and knowledge on this. So I always like to end the conversations kind of on a fun note, lighthearted note. Are there any good fun stories you've had? Any vacations, time away, anything interesting happening that you'd like to share?
Maybe one of them that comes to mind. So in a previous job, we had a work function which finished around 9 p.m. in London. And as we were coming out the building, we bumped into Tom Jones. You've heard of Tom Jones, right?
Yeah.
Yeah. And the people I was with, they said, "Oh no, we need to have a photo with him." And I said, just leave the poor guy alone. He's obviously out himself. He probably doesn't want
Yeah.
us having photos with him. But what a great person. He allowed me to take photos of my colleagues and him, and then as they finished, he just said to me, "Would you like a photo with me?" And I thought, "Oh wow, what a gentleman." He didn't have to do that on his night out. So yeah,
Right.
so that's a fun story, but also one about human nature, which is great.
I often that's a great story, and um sometimes you're intimidated by big celebrities like that. So here in Tahoe, we have a celebrity golf tournament that is just huge. American Century Investments sponsors it, and it's broadcast nationally. And some of the biggest names in sports, like Steph Curry, we get some soccer players. Michael Jordan used to come, Charles Barkley, some huge names would come. And I just love it. I'm not one to go out and get autographs or pictures, but I love it when these bigger than life celebrities allow little kids to, get autographs. And of course there's celebrities that don't have time for it and stuff, but like Steph Curry, they will take their time out to talk to people and take pictures. They're not bigger than life what they seem. They can be very humble in a lot of things, and I think it's fantastic when they do, especially when it comes to little kids, and they just make little kids their day, their life by calling them out. So that's fantastic.
Yeah, they give them memories, don't they? And teach them about humility, as you said.
Yeah, exactly. And like now you've created these fans of yours for forever by just signing your name on a jersey. But I like that more than actually watching the golf, is just the interaction. And then of course you have some celebrities that are shotgunning beers and taking shots on the golf course, and that's always fun too.
Oh, the joys.
Yes, exactly. The simple things in life, Dorothy, that make me happy.
Yeah, me too.
Awesome. Well, that's fantastic, Dorothy. Thank you so much to Dr. Dorothy Kelso for bringing such great insight and expertise on such a great topic that it's capturing headlines more, but I think there's still a lot more uncertainty out there regarding private markets because it is, earmarked, supposedly earmarked to the wealthy and affluent, whereas I think that's coming down now, and that's why we're getting so much more questions about it and topics about it, because now more of your average retail investors like myself are getting access to alternatives and private credit and alternatives. So quickly, Dr. Kelso, where can our audience get more information about Super Return and upcoming events?
Oh, thank you for the plug, Ryan. Really appreciate it.
Yeah.
www.superreturn.com. That's a good place to go. Thank you.
Fantastic. Awesome. Thank you so much, Dr. Kelso, for coming on the show. I really appreciate it. And to all of our guests, you can find and listen to all of our Adjusted for Risk podcasts on episodes on the Adjusted for Risk YouTube channel, as well as on Spotify. Thank you very much and have a great rest of your week.
Thank you, Ryan. It's been a real pleasure.